welcome back to the Choice of Entity web series. Another issue I want to discuss is, in addition to the income tax consequences on your operations of the business, there's other tax issues that the business owner should be aware of. Specifically, it's the tax on formation and liquidations that I want to address here, as well as employment taxes. That's another big issue that everybody thinks about. And here, for these issues, generally the corporation is the odd man out here. On formation and liquidation of businesses for sole proprietorship, general partnership, and limited liability companies, generally they can be done tax efficiently without any tax on the transfer of assets to the business or the transfer of assets out of the business at the end at the liquidation. Now, there are always exceptions to this rule, and every situation is different, but for the most part, these events can be done in a tax efficient manner. For a corporation, however, certain rules have to be complied with. On formations, a corporation most likely you will be able to form a corporation and transfer assets in tax-free, but there are rules that have to be complied with, and every now and then somebody will get tripped up, not comply, and then be subject to tax on the formation of a corporation. So you need to make sure that you're doing it right. Similarly, on the liquidation of a corporation, there will be a tax to pay. The liquidation of a corporation, it's treated as if the corporation sold its assets. There's a gain on the sale, there's a tax to pay, and then a tax on the dividend out to the shareholders, a second level of tax. This tax may be mitigated in the circumstances of an S corporation, and that second level of tax may be mitigated, if not eliminated, but it's an issue that needs to be addressed in the context of a corporation. So for formation and liquidations, for the most part, you can do it efficiently in the entities, except the corporation. There's a lot more formalistic procedures that need to be followed to make sure that you're getting the right tax consequences. Another issue that comes up all the time is employment taxes. Again, if you're conducting business through a corporation and also working for that corporation, you need to pay yourself a reasonable salary, and that salary will attract the appropriate employment taxes. However, all of the excess earnings, in addition to your salary, the profits, they can be earned and distributed out to you without attracting any employment taxes. So it's only your reasonable salary that's attracting the employment taxes. However, if you conduct business through a sole proprietorship, general partnership, limited liability company, and if you're a general partner in a limited partnership, all of the earnings of that business will be subject to self-employment tax, regardless of whether you're earning a reasonable salary or not. With respect to a limited partnership, the exception to that rule is if you are a limited partner in a limited partnership, then your earnings would not be subject to self-employment tax, specifically because of the rules that dictate that you're not allowed to be working for the business and you have to be a passive investor, so then therefore your earnings are not subject to self-employment tax. So with respect to self-employment taxes, if that's a big issue, corporations may be more favorable because only your earnings, your reasonable salary, is subjected to it. All your other profits are not subjected to it. But for the most part, other than that exception for the limited partnerships, all the other entities, 100% of the profits will be subject to self-employment taxes.